If you think about the balance sheet, what we're basically trying to see is this 100,000 has moved to 100,200. Now, because all of this balances out, the $200 increase, net increase in cash has to be offset by a $200 decrease on basically everything else. So we need to have a look at all the effects that have happened. And there are only 3 things left to look at, and only 2 of which we need to deal with. Debentures and ordinary shares, which are financing activities. Retained earnings, in this particular case, we don't necessarily need. I would do it, and I'll tell you why you should double check with it, and I'll double check it in your own time, but it is a good idea to double check what information you have about retained earnings for a very good reason, which we'll get to in a moment. But with debentures and ordinary shares, let's have a look at the additional information. Do we say anything about it? That talks about net profit, that talks about dividends, which are nothing to do with debentures or ordinary shares. So that just means all we're looking at is how that amount has changed, and then with ordinary shares, how that amount has changed. Because a change in the ordinary share account, when shares change in value out in the market, that's not being reflected in the book value. That's actually, have you issued more shares or have you bought shares back? The share issue doesn't have to be for cash. The share issue could be for something else. It could have been a conversion of an equity, a conversion of a convertible note into shares. So you need to keep an eye out on what else could have caused it. But given nothing else exists in terms of the additional information, this, and it's gone from 156 to 157, so that is an issue. There has been cash coming in. The debentures has gone from 97 to 84, so your total amount of debt has gone down from 97 to 84. There is money that has gone out. And all that we're doing is picking up that difference. If you really want to, you can do T accounts for those. And because I'm going to do it in the longhand, we'll actually do that. So with debentures, really quickly, debentures move from 97,610 and they end up at 84,390. We get told no other information, so that has been an outflow. And the amount of the outflow is, that's about 13,000 if you work it out exactly. It is 13,220. We're running out of room. So we have 13,220 being the cash outflow for repaying that debt. And when we look at shares, and this is a ridiculously small number. I don't know, it's not realistic. But shares have moved from 156,870 and have ended up at 157,430. So we can see share capital has increased a very, very small amount. No other information exists about them. We know it's increased, so we can actually just put that in, and that increase is, Christ, that'd be just taken up with investment banking fees. There's no point issuing that small an amount. Anyway, so 156, $560. It's not gone up by an awfully large amount of money. We assume it's cash. We throw in 560 on that side. And we are so close to being done. The last thing that we need to deal with is dividends. Now, in this particular question, that was actually fairly easily done because as additional information point 3, we actually just say dividends declared and paid was 71,280. You know explicitly how much those dividends were. And because I've run out of room, I'll be really lazy with this last one and just leave it. But we know the cash flow effect from that because they were paid. 71,280, so cash has gone out. When we take it in totality, we can see that 71,280 come up down here, so that's just the dividends that were paid. We can see the repayment of the borrowings, so the debentures which have gone down over here, and we can see the proceeds from the issue of share capital, and we've worked that out. That means in terms of financing, you have been paying back, funds, so you haven't been borrowing money or investing or getting share capital to purchase that new property, plant, and equipment. It is internally generated. Add them all up and you end up with a net increase in cash held of $200, which is what you want. Now, the one comment I just want to make is, again with dividends, have a look. Are there dividends declared but not paid? Because that will feed through. You need to have a look at what's going on there. Are there dividends payable in the accounts? What's happening with them? You don't necessarily need to have dividends. We could have figured that out, the dividend amount, without telling you about it. Because what we've told you is we have given you profit and we've given you retained earnings. So we know what retained earnings have changed by and we know what profit is. You can work out what the difference is, and that's going to be a dividend effect, assuming there's no other movements in reserves. So you could actually work it out that way. That is a full statement. That was obviously a lot to do. Sometimes I think you may see, there may have been a past paper where you saw a full cash flow statement. Certainly you've seen portions of cash flow statements turn up in past exams. We're going to flick back to the slides now and then just a couple of small admin things and we're done for today. So, it's a lot of working out. And that's not, it's a wrong computer. Okay, so regulation, you need to understand what the definition of cash and cash equivalents are and what that means for the cash flow statement, why we prescribe how we disclose this information. If they just have to tell us, like at the end of the day, you just look on the balance sheet, there's $100,000 sitting at the start, there's $100,200 sitting at the end. It's gone up by $200. You know that. You don't need a cash flow statement to tell you that. Again, to think about why is it helpful to know how that movement has occurred. So it's different to income, it's useful. And regulation is predominantly about presentation.